All right, let's jump right into this explainer. Today, we're mapping out nVent's strategic roadmap, specifically looking 18 to 24 months ahead. They just dropped their Q1 2026 numbers. And honestly, rather than just giving you a standard recap, we're going to use this data as a lens. We want to understand exactly how they're positioning themselves for what looks like a massive incoming industrial supercycle. So, to figure out their trajectory, we've got to ask the multi-billion-dollar question: how is nVent gearing up to capture the AI infrastructure boom over the next 2 years? Look, we hear about the software side of AI all the time, right? But the hardware is absolutely just as critical. Think about the sheer amount of heat generated by servers running those insane algorithms. The data centers, the power grids, the advanced cooling systems, that's the physical foundation of this whole revolution. And nVent is sitting right in the middle of it. And get a load of how much their target playground has expanded. When nVent first spun off, they were looking at a $60 billion total addressable market. Today, that opportunity has ballooned to $130 billion. Why does that matter for us? Because it puts a very real, very hard number on the tidal wave they're trying to ride into 2027. This electrification trend isn't just growing incrementally. It's expanding their market at an incredibly rapid rate. Now, to actually chase that $130 billion market, their entire portfolio mix has had to undergo a drastic shift. Check this out. 56% of their business is now entirely concentrated in infrastructure. At the time of their spinoff, infrastructure was just 12% of the whole operation. So, looking out over the next 18 to 24 months, this specific sector, fueled heavily by data centers and power utilities, is engineered to be the absolute bedrock of their revenue. And nVent's CEO, Beth Wozniak, really hits the nail on the head regarding the intent behind this. She explicitly states that their portfolio transformation and the AI data center build-out are what's accelerating their growth. This is a highly calculated pivot. They're actively pulling away from slower-moving sectors so they can supply the hardware, the thermal management, and the electrical connections that literally make the AI revolution possible. Okay, let's pivot to tactical execution. Here is their 24-month roadmap, specifically focusing on capacity and innovation. Looking ahead, their 2026 operating objectives really center on a few core pillars. They're targeting those high-growth verticals, deploying capital strategically, and this is key, driving supply chain resiliency. Because let's be real, you can't capture a $130 billion market if your supply chain snaps under the pressure. Grounding this in reality, building a bulletproof network of suppliers is exactly how they plan to shield their margins from any bottlenecks over the next 2 years. Unpacking that strategy a bit further, their immediate next step involves expanding capacity at their Blaine facility. They're pouring resources into their physical manufacturing footprint right now. Why? To support a huge wave of new product launches coming in Q2 and Q3. The whole operation is engineered to keep up with this seemingly endless demand coming from hyperscalers and multi-tenant data centers. And this slide brilliantly illustrates why those new product launches matter so much for their 24-month strategy. In just the first quarter alone, new products contributed over 20 points to their sales growth. Innovation isn't just a buzzword here. It's an active, working engine generating immediate market share. If they keep up this pace of rapid prototyping and deployment, their competitive moat is going to be incredibly tough to cross. So, beyond organic capacity, let's explore their secondary growth engine for the next couple of years: strategic mergers and acquisitions. They've got a serious track record here. Successfully integrating acquisitions like Eldon and ECM Industries proves they don't just build in-house. They have a highly proven capability to absorb external assets and weave them right into the nVent ecosystem. It's this dual-pronged approach that's allowing them to scale fast enough to meet the broader market opportunity. But importantly, they aren't just bulking up for the sake of it. They're maintaining strict financial discipline, targeting a return on invested capital that's greater than their weighted average cost of capital within 3 years. To translate that out of finance exam jargon, they're basically making sure the money they spend on an acquisition generates returns faster than it costs to borrow that cash. It's smart, careful shopping to protect their balance sheet heading into 2027. And you know what? The data shows this disciplined approach is actually paying off. Their recent Electrical Products Group, or EPG, acquisition is already performing well ahead of corporate expectations. It's fueling their near-term momentum and proving that their integration skills are incredibly sharp, which gives us a great blueprint for any future M&A they tackle over the next 24 months. All right, let's pull up the financial scorecard and look at the actual numbers validating all of this strategy. Their Q1 results are just a massive launchpad. Sales surged 53% to $1.24 billion, with organic growth making up 34% of that. And their adjusted operating income? $249 million. This data just flat out proves that their aggressive pivot into infrastructure is currently yielding the exact financial dividends they need to fund the next 2 years of expansion. But wait, here is the number that absolutely anchors our 18 to 24-month forward analysis. $2.6 billion. That is the size of their current backlog. Think of a backlog like a massive, guaranteed paycheck just waiting in the mail. Even if they didn't win a single new contract tomorrow, they are sitting on a huge reserve of pent-up future revenue. It's an incredible safety net, and it really shows how much infrastructure demand is de-risking their immediate future. Because of all this crazy momentum in the data center space, they've actually significantly upgraded their 2026 full-year guidance. They were originally projecting 15 to 18% sales growth, but they've bumped that up to an expected 26 to 28%, along with a boosted adjusted EPS. That sends a very clear signal of strong corporate confidence that this demand is durable over the coming quarters. Zooming in specifically to the immediate horizon of Q2 2026, we see organic growth projected at 23 to 25%, with recent acquisitions stacking on another 5%. So this basically illustrates that both their internal innovation and their M&A engine are firing on all cylinders simultaneously to hit these elevated targets. So as we wrap up this explainer, here's the ultimate question we're left with. Will nVent's disciplined capacity expansion and aggressive M&A strategy actually be enough to outpace the breakneck evolution of this $130 billion AI infrastructure market over the next 2 years? Can their execution continue to match the unprecedented hyperscale speed of the global AI revolution? I mean, they've got the backlog, they've got the roadmap, and they absolutely have the momentum. Keep that question in mind as you watch the tech and industrial landscape evolve. Thanks for learning with me today, and definitely keep your eyes on the data center space.